A vault door opens in a central bank basement in Warsaw. Inside, workers stack freshly delivered gold bars, 150 tons purchased in a single quarter of 2026. 6,000 miles away, in Riyadh, a tanker full of crude oil is sold for Chinese yuan, not dollars. For the first time in 50 years, the buyer did not need a single American banknote to complete the transaction. In Washington, a digital counter on the Treasury Department website ticks upward at a rate of $92,000 per second. Nobody on the evening news mentions it. The map of the world just shifted, and while most are looking at the headlines, the real story is happening inside your bank account. Welcome back. What is about to be laid out in the next 25 minutes is not opinion. It is a sequence of published, verifiable data points from the Federal Reserve, the Congressional Budget Office, the World Gold Council, and the International Monetary Fund. The connections between these data points have not been widely reported, but once they are placed side by side, the picture they form is unmistakable. The invisible tax of inflation is moving faster than the news cycle. While the world watches trade routes shift and negotiations unfold, the purchasing power of the dollar in every wallet is quietly eroding. The cost of not understanding what is happening right now is not theoretical. It is measurable, it is compounding, and it accelerates with every quarter that passes without attention. Here is where the story begins. As of January 2026, total United States federal debt stands at $38.43 trillion. 1 year ago, that figure was $2.25 trillion lower. The national debt is growing at approximately $8 billion per day. That translates to $334 million per hour, $5.57 million per minute, $92,912 every single second. These are not projections from outside analysts or estimates from independent researchers. These are published figures from the Joint Economic Committee of the United States Congress, updated monthly. The annual cost of servicing this debt has now crossed the $1 trillion threshold. For the first time in American history, interest payments alone exceed the combined budgets for national infrastructure and multiple domestic programs. To put that in perspective, the government now spends more money paying interest on past borrowing than it spends building roads, bridges, and airports. The debt is no longer funding the future. It is consuming it. The Congressional Budget Office projects that federal debt held by the public will reach 120% of GDP by 2036. That figure has never been recorded in the nation's history, including the period following the Second Global Conflict. Under more aggressive modeling that accounts for recent legislative changes, the Committee for a Responsible Federal Budget estimates debt could reach 131% of GDP within the same time frame. The acceleration is not linear, it is compounding. The CBO further projects annual deficits growing from $1.9 trillion in 2026 to $3.1 trillion by 2036. Revenue is rising, but spending is rising faster. The structural gap between what the government collects and what it spends is widening with each fiscal year. Economists refer to a specific mathematical threshold known as R greater than G. This is the point at which the interest rate on government debt exceeds the rate of economic growth. When this line is crossed, the debt begins to feed on itself. The government borrows more to cover the interest on previous borrowing, creating a cycle that no amount of growth can outpace. The CBO's latest modeling indicates this threshold will be crossed later in this decade. Once it is crossed, the fiscal trajectory shifts from a policy challenge to an arithmetic certainty. Analysts at the Committee for a Responsible Federal Budget have described this dynamic explicitly as the mechanics of a debt spiral. The term is theirs, published in their official reports. Historical records show that every nation that has crossed this mathematical threshold underwent a significant monetary restructuring within the following 2 decades. No documented exception exists across 5 centuries of sovereign finance. Spain crossed this threshold in the 16th century and experienced 6 consecutive sovereign defaults. France crossed it in the 18th century before its paper currency system disintegrated entirely. Britain crossed it in the 20th century, and within 3 decades, the pound had lost its position as the world's primary reserve currency. 3 nations, 3 different centuries, 3 different continents. The outcome was identical. The pattern does not merely suggest what follows. It specifies it with a mathematical consistency that has not been successfully contradicted by any economic model. To fully grasp the weight of what is happening now, one must understand the mechanism that has sustained the dollar's dominance since the early 1970s. Because the dollar was not always dominant, and the system that made it dominant was never designed to last forever. In 1944, 44 nations agreed to peg their currencies to the dollar, and the dollar was pegged to gold at $35 per ounce. This system, built at a conference in New Hampshire, functioned for 27 years. It worked because the United States held 75% of the world's monetary gold and produced half of its industrial output. The asymmetry was so complete that no alternative was possible. But the system contained a fatal flaw identified by economist Robert Triffin in 1959. For the global economy to grow, more dollars had to circulate. For more dollars to circulate, America had to run deficits. But deficits eroded confidence in the gold promise. The system needed deficits to function. The deficits would destroy the system. Both were true simultaneously. No policy could resolve it because the flaw was mathematical, not political. By 1971, gold reserves had fallen by half. On August 15th, the convertibility of the dollar to gold was suspended. The announcement was framed as temporary. It was never reversed. What should have followed was decline. Every prior currency that lost its backing entered a sustained period of erosion. The Dutch guilder faded for 50 years. The British pound weakened for 3 decades. The dollar did not decline. Between 1973 and 1975, a series of agreements with Saudi Arabia created a new anchor. All energy exports would be priced in dollars. Surplus revenue would flow into treasury securities. The dollar was no longer backed by gold. It was backed by the global demand for energy. Every industrial economy needed petroleum. Every barrel required dollars. The mechanism created permanent structural demand. This system allowed the United States to sustain deficits that would have been unthinkable under any prior framework. Dollars flowed out. The world sent them back as treasury purchases. The cycle was self-reinforcing. No nation in history had ever achieved this arrangement. But no arrangement built on structural dependency rather than fundamental strength has persisted indefinitely. The system functioned for approximately 4 decades. That stability is now ending. While the debt data tells one part of the story, the second major shift is happening in central bank vaults around the world. This is the part that most people are not watching closely enough. In 2022, a major international financial dispute led to the freezing of over $300 billion in foreign central bank reserves held in Western institutions. The structural signal was received immediately by every national treasury on Earth. The message was unambiguous. Reserves held in foreign institutions are not unconditional property. They can be frozen, restricted, or revoked based on policy decisions made by the host country. The response was not theoretical. Central banks began purchasing gold at a pace not seen in over 60 years. The trend has not slowed since. It has accelerated with every quarterly report. According to the World Gold Council, central banks purchased over 1,000 tons of gold annually for 3 consecutive years, from 2022 through 2024. That rate is more than double the average from the prior decade. In the first half of 2025 alone, central bank gold purchases reached 410 tons. The second quarter of 2025 saw a 41% increase above the historical quarterly average. By the end of the first 9 months of 2025, nations aligned with the expanding economic coalition had collectively purchased 663 metric tons of gold. That is approximately $91 billion in a single 9-month period. Global central bank gold reserves now exceed 36,000 tons. The share of gold in central bank reserves worldwide has risen from 10% in 2000 to over 17% in 2025. Poland's central bank approved a plan in January 2026 to acquire 150 additional tons of gold, aiming for a total reserve of 700 tons. The stated goal is to bring gold to over 30% of total reserves. India's gold reserves have reached a record 16% of total foreign exchange holdings. Brazil re-entered the gold market dramatically in late 2025, purchasing approximately 43 tons in a single quarter. A World Gold Council survey conducted in 2025 revealed that 73% of global central bankers believe the dollar's share in reserves will decrease further over the next 5 years. This is not speculation from outside commentators. This is the internal expectation of the institutions that manage sovereign wealth. Simultaneously, the dollar's share of global foreign exchange reserves has fallen from 72% in 2000 to approximately 56% in the second quarter of 2025. That is the lowest level recorded in 3 decades of IMF data. The movement is not random. It is coordinated, accelerating, and visible in every quarterly report published by the International Monetary Fund. The data is directional and sustained. While central banks restructure their reserves, the third and perhaps most consequential shift is unfolding in the global energy markets. This development strikes directly at the foundation of the dollar's role in the world. Since the mid-1970s, the dollar's global dominance has been anchored by one mechanism: the pricing of international energy transactions exclusively in dollars. That exclusivity is now ending. Saudi Arabia has begun accepting alternative currencies for energy exports. Major bilateral energy agreements between the world's largest economies now settle in yuan, rupees, and other non-dollar instruments. The expanding economic coalition launched a pilot digital settlement instrument in late 2025, partially backed by gold and designed specifically for cross-border trade between member nations. The instrument was deployed on blockchain infrastructure. Digital payment systems are being built to enable large-scale transactions that bypass the traditional dollar-based clearing system entirely. Multiple cross-border pilots are already processing volumes measured in the trillions. The coalition now represents approximately 46% of the world's population and 37% of global economic output. These are not peripheral economies. They are the manufacturing centers, energy producers, and commodity exporters that form the backbone of global trade. New precious metals exchanges have been announced where physical gold and other commodities can be traded directly without dollar intermediation. The parallel infrastructure is not a blueprint. It is operational. Bilateral trade agreements denominated in non-dollar currencies now span 4 continents. Each new agreement adds a node to a network that functions independently of the dollar clearing system. No single development is decisive in isolation. Together, they represent the simultaneous erosion of every structural pillar that has sustained the dollar's unique position for 50 years. Given these 3 converging forces, the debt trajectory, the reserve diversification, and the energy market restructuring, analysts have outlined 3 potential scenarios for the coming decade. Each is grounded in documented precedent and current data. Scenario 1 is the optimistic outcome. In this scenario, policymakers implement meaningful fiscal reforms that reduce the structural deficit and restore confidence in the long-term trajectory of American sovereign debt. The dollar retains its primary reserve status, but shares the stage with other settlement currencies and digital instruments. The transition is gradual, managed, and spread over 2 to 3 decades. Purchasing power erodes slowly but predictably, at a rate that allows institutions and individuals time to adjust their positions. This is the smoothest possible outcome. Historical precedent suggests it is also the least likely. No documented case exists of a dominant nation voluntarily reducing its fiscal commitments while simultaneously maintaining its global financial role. The political incentives consistently favor the opposite direction. Scenario 2 is the baseline outcome. This is the trajectory that current data projects, if existing trends, continue without significant policy intervention. The dollar's share of global reserves continues its measured decline, falling below 50% within the next 5 to 7 years. Alternative settlement systems reach full operational maturity. The cost of servicing national debt consumes an increasing share of federal revenue, systematically crowding out spending in other categories. Interest payments rise from 3.2% of GDP in 2025 to an estimated 4.6% by 2036. Purchasing power erosion accelerates beyond current reported inflation rates as confidence weakens among international holders of dollar-denominated assets. The adjustment is uneven and disproportionately favors those with diversified holdings. This scenario closely mirrors the trajectory of the British pound from the 1940s through the 1970s. A slow, steady, fully measurable decline that was visible in the data decades before it was acknowledged in public policy. Scenario 3 is the severe outcome. In this scenario, a confidence disruption triggers an accelerated unwinding of dollar-denominated reserves by multiple central banks at the same time. The triggering event could be a failed treasury auction, a sovereign credit downgrade, a rapid expansion of the alternative settlement network reaching critical mass faster than projected, or a combination of simultaneous pressures. The historical parallel is the Asian financial disruption of 1997, where a single regional currency adjustment propagated across 4 continents within 18 months. The dollar's integration into global finance is orders of magnitude deeper than any regional currency. In this scenario, purchasing power comes under extraordinary pressure within a compressed time frame. The adjustment is concentrated rather than gradual, and those without advanced preparation absorb a disproportionate share of the economic impact. The documented record of monetary transitions across 5 centuries shows a pattern that has never once varied. The cost of transition is distributed inversely to access and information. The German currency crisis of the early 1920s eliminated middle-class savings within months, while those holding tangible assets preserved their purchasing power almost entirely. The British currency adjustment of 1967 reduced purchasing power for ordinary citizens, while financial institutions had repositioned years in advance. The same pattern repeated in South American currency disruptions and in the Asian financial disruptions of the late 1990s. Those with advanced knowledge and financial flexibility adjusted their positions before the shift. Those without that access bore the full weight. This is not speculation. It is the single most consistent outcome in the entire documented history of monetary system changes. The pattern spans 5 centuries, 3 continents, and every type of monetary framework. Regardless of which scenario unfolds, several structural realities are already established by the mathematics. The debt trajectory is set. The reserve diversification trend is measured and accelerating. The alternative settlement infrastructure is under active construction. The energy market's dollar exclusivity is ending. These are not predictions about the future. They are measurements of processes already in motion. The Federal Reserve balance sheet expanded from under $1 trillion in 2007 to nearly $9 trillion by 2022, a 9-fold increase in 15 years. Each emergency intervention was described as temporary. None were fully reversed. Each intervention stabilized conditions in the short term while accelerating the underlying structural pressures in the long term. The documented pattern mirrors the late stages of every prior monetary system. Interventions of growing magnitude producing diminishing returns. The dollar is currently embedded in 88% of all international currency transactions. Dollar-denominated obligations held outside the United States exceed $13 trillion. Central banks worldwide hold roughly 58% of their reserves in dollars, down from 73% 2 decades ago. The decline is steady, measurable, and shows no indication of reversal in any quarterly data. A disruption at this scale would not be contained to one region or one sector. It would propagate through every connected economy simultaneously. The scale of global financial interdependence is without historical parallel. The financial disruption that began in Thailand in 1997 spread across 4 continents within 18 months. That event involved a single regional currency with limited global exposure. The dollar is not regional. It functions as the operating infrastructure of the entire global financial system. Every trade route, every supply chain, every international contract is denominated in or passes through it. A disruption to the operating infrastructure does not affect one participant. It affects every participant connected to it. In the current system, virtually every economy on Earth is connected. The interdependence is total. The builders of the next monetary framework are already at work. Digital settlement systems are in active development across more than 130 countries, with several already processing live transactions. Sovereign gold reserves are being accumulated at the highest sustained rate in 6 decades. Central banks are not merely purchasing gold on the open market. They are repatriating physical reserves from foreign vaults back to domestic storage. New clearing mechanisms are being constructed to process non-dollar trade flows. Cross-border digital payment pilots, coordinated by the Bank for International Settlements, are refining the technology that will underpin the next generation of settlement systems. The architecture of a new financial order is being assembled in real time. The blueprints are public documents. The investments are quantifiable. The timeline is accelerating with every quarterly data release. The question is no longer whether a transition will occur. The data has answered that question. The question is whether the transition will be orderly or disorderly. If orderly, the cost will be significant but manageable. Institutions will adapt. Portfolios will restructure. The adjustment will be measured in percentage points of economic output across a generation. If disorderly, the cost will reshape economies for decades. Savings will erode. Purchasing power will shift dramatically between nations. The adjustment will be measured not in percentages, but in generational economic realignment. The documented record, spanning 5 centuries of monetary history, converges on a single conclusion. These cycles are structural, recurring, and precisely measurable. The specific details change with each era. The sequence never does. Dominance enables the currency's rise. Success gradually erodes the advantage. Overextension accelerates the erosion. Obligations compound beyond the capacity of growth to service them. Confidence weakens. Alternatives emerge. The transition begins. Every central bank that is currently accumulating gold at record pace has access to the same data presented in this analysis. The question is not whether they see the pattern. Their purchasing records confirm they are already acting on it. The relevant figures are published quarterly by the Federal Reserve, the Congressional Budget Office, the Bank for International Settlements, and the International Monetary Fund. Every indicator is available in their public reports. The trajectory of the debt, the pace of reserve diversification, the growth of alternative settlement systems, the declining share of dollar reserves in central bank portfolios worldwide. It is all published. It is all measurable. The information is not hidden. It is simply not widely understood. The distance between what the data shows and what the general public believes grows wider with every quarterly report. So the question that remains, and it is the only question that ultimately matters, is this. If the institutions managing trillions in sovereign wealth are repositioning at the fastest pace in 60 years, what does that signal to everyone else? The data is clear, the patterns are repeating, and the clock is ticking. Stay informed.